Well, good evening and welcome to this live stream on the 6th of May, 2025. Don't know where this year's going. It's going way too quick. It's Martin North here from Digital Finance Analytics. Great to see you on the stream tonight. Thanks for taking some of your time out on a Tuesday evening. And important show tonight. We're going to dissect the last month in terms of the election, what's happened with the Trump tariffs, the markets. Oh, there's a few things to touch on this evening. Plenty of different elements, and we're going to try and make some sense of it, and hopefully give some practical investment thoughts as well in terms of people trying to work out what to do. There is a question in the poll on the chat asking about whether you've changed your plans as a result of the election. Significantly or hardly at all or not at all. So if you have a chance, put your answers in there. We'll perhaps use that as we go a bit later. Sometimes I don't use the answers in the poll because it may not be that useful or helpful, but if it is, then I'll use it. Anyway, before I bring Damien in, just remind you, as I often do, we don't provide financial or legal advice on this channel. This is a general conversation only. We moderate the chat, but feel free to throw your questions, comments, and suggestions in as we go. There's always a lot of conversation going on. I won't necessarily follow all of it, but if you want to get a question to me or Damon, if you use that word, the world, that'll make sure it comes up on my queue, and then I can actually bring it into the show. I've also enabled Super Chat, which means that you can get your question to the top of the list, or indeed make a contribution to what we do around here. Really appreciate all of those who help us to finance what we do. We don't do this for profit. We do this because we think that's a really important conversation to have, and never before, perhaps, given what's happened recently. Right, with that done, let me bring Damien straight in. Damien, welcome. How are you?
Martin, not too bad. Yeah, it's been exciting times as usual.
It's been a very quiet month. You know, you could almost have gone away and done nothing, right?
Well, and it's markets have almost retraced all the fall which we had as well. Like it's pretty decent fall post Liberation Day, and most of it's all sort of come back. So I'm sure we want to talk about that at some point, but let's and
it's interesting because you and I had a conversation, this time last month, just around the time the tariffs were announced, and we said that the volatility in the markets were likely to exacerbate, but people shouldn't panic, right? Because markets tend to overreact. They tend to do a lot of shifting around. And I don't know how much of the shifting around was due to hedge funds taking positions, due to investors going to cash, due to people just having higher levels of uncertainty than previously. It's been quite difficult to read what was driving the market down, but now, of course, it's come back. Is it because Trump is all bluster and rather than real stuff?
Look, the question, is a storm already happened and we're just sort of picking up the pieces now and trying to work out how bad it was and the damage? Or is this the calm before the storm? We're sitting in the eye of the hurricane, so to speak, and we're about to see all the fundamental problems hit. And, I think by the time we talk again next time, we'll have a much better feel for it. Assuming, because I think there's a whole bunch of things that obviously keep getting pushed out. So it's an announcement of something and then push it out, an announcement of something and push it out, and then take it off. As soon as it's like, oh, there's going to be, we were joking in the pre-show. There does seem to be some of this part where it's like, well, you're a CEO who came to my inauguration and gave me a lot of money. Maybe I should take the tariffs off your products, and we'll keep producing your products at the same rate. And so there's obviously the confusion part of it, and that's the part I think is the most dangerous. And the question we're hitting at the moment is there's sort of three stages that you'd expect it to go through on the disruption side of the supply chains and everything. And the first step is the containers stop. So what's coming out of China, they may be still producing it and stockpiling it, but they've stopped sending it on ships, and that part's happened. And we're starting to see that as we speak. Container volumes are really falling away at the major US ports, and we can see from the ships that are in transit, there's no recovery to that. The second part then is you start seeing the truckers and delivery part really start to take a hit, and keeping in mind that that's a pretty reasonable part of the American workforce, and that there's a lot of they're effectively small businesses. You know, they own their own truck or lease it from someone and work for those. So that's still going to be affecting. Plus the retail, and the question is, are there going to be sort of holes in the retail stores, holes in the retail shelves for goods, and so that stuff we're going to see over the next 2 or 3 weeks start to play out. And then the final part is, if that's then seen as being an ongoing thing, then you start to see the layoffs, and within those industries, they do tend to be sort of industries that employ a lot of people, and so that's where you can see those layoffs happening. So the question is, are we going to go through that, or are we going to get halfway through it and then all of a sudden a bunch of things will get rolled back, and then at that point maybe you see a bit of that initial pain, but you don't see the layoffs. And that's what I think the markets are really sort of looking at the moment is, okay, how much genuine harm is going to come from this CapEx cease? And sorry, I'm keeping in mind that the CapEx stuff, that in terms of people not spending new money in terms of capital expenditure in the US, that takes a while to play out. These aren't projects or most of these aren't projects that you just suddenly decide one day, let's go and build a factory. They're often years in the planning. And so the cancellation of some of these, the same part is, I started to build this thing. Now I don't know whether I need to build it or not. How far am I in? If I'm 90% of the way in, well, I'm probably just going to have to bear it. If I'm only 5 or 10% of the way in, maybe I can pull out and take a small loss or whatever is on it. That's the part where, even still, if I've decided as the Trump tariffs hit, right, that's it, I'm going to cancel this project, I've probably got another, couple of months of spend anyway, just in terms of winding up the project. So it's very difficult to see what the fundamental effects are going to be, and that's the part everyone's really guessing at. Now, if you look at markets, it's very much been retail investors who have bought back in and have basically assumed that, look, Trump's bark is worse than his bite, and so it'll probably be all right. The institutional investors have largely stayed away. That's not to say they're definitely going to be right, or one side's definitely going to be right and one side's definitely going to be wrong. But I do think there's a real divergence in terms of the expectations now, and the thoughts around, look, how much damage has really been done by the chaos and the this is on, it's off again, it's double, it's triple, it's halved, it's back to 10% on these countries, and that's the part that's very difficult to tell. Oh, sorry, and the other part that's difficult to tell is huge in China, especially in their social media circles at the moment, is how do you ship your goods to Malaysia and Bangladesh and then rebrand it as made in Malaysia and ship it to the US to avoid, take it from 145% to 10%. And they're obviously very active in terms of that. Now, is that going to be, is that a way around this? And does Trump effectively go, well, I've caused enough chaos. If I crack down on that, then the shelves really will be empty. Or does he just go, oh, well, I'll look the other way for a little bit and until we settle down, and then I'll do it? Or does he just come out swinging and go, right, Malaysia, now you've got 145% until you stop that, and then and just go country by country, and nobody really knows. You can certainly see some best case scenarios where it's sort of like, well, and another one is these are being fought in the courts as well. Like, does Trump genuinely have the authority to be able to do this unilaterally? And maybe a judge will come out and decide that, because it does look like you, for the most part, unless you're into some sort of, in terms of war and other sort of extraordinary circumstances, it does look as if, this power resides with Congress, and you need to have laws and everything passed, which may or may not pass, but maybe they get reversed in the courts and it's zero for a little while he makes some token attempts to push it through. So, there's all these different factors you could see coming through that still means, the number of potential outcomes is extremely high.
Yeah, and a couple of observations. I mentioned, I think, in the pre-show, the movie tariff, right? And it's quite interesting because the prospect now is movies outside the US will be hit by 100% tariff. How they can do that, goodness only knows. But the point is, he directly linked it with security risks, right? And that, of course, is because the only way that he can really impose these without Congress is to argue it's a national security issue.
Yes.
And so that's, I think, a really interesting observation. And that will be tested in the courts at some point. The second point, the S&P 500 is now, back up to where it was, not off the very highs, but it dipped down and then dipped back again. And as a result of that, the PE on average is about 21 times, which is very high, especially given the likes of Ford Motor came out and said, well, actually, we think that our results will be significantly lower ahead because of the tariffs than we expected by a chunk of their quarterly return, which suggests that their price earnings ratio is probably a bit aggressive. Now, it's interesting if you look at Ford as a chart. This is actually the Ford Motor Company. You can see that it dipped way down, earlier on. It's come back a little bit now. It's at sort of 10. But the question is that a legitimate price if in fact their earnings are going to be significantly lower simply because of the fact that now, they're going to have to pay the tariffs? And retail, of course, as well. If you look at retail, what you discover there is that some of the big retailers are now saying, well, we just don't have stock. Stock is going to disappear from our shelves in a couple of weeks' time because it's a slow-moving problem insofar as the shipping has sort of stopped. It's going to not arrive, and then it's going to get, over the rest of the country. So this is going to play out over quite a long time. But my question, I guess, to you is, should we reset the expectations of US earnings ahead, or is this, again, overdone?
I think, look, there's definitely sectors where it needs to be reset. Now, some sectors, say the travel sector, for example, has fallen away a fair bit and hasn't really come back. So it's sort of interesting in that it hasn't been, there's certain sectors where they've fallen a fair bit. They bounced back a little bit, but nowhere near back to where they were versus, say, the tech sector, which has come most of the way back. And so, so it really does depend upon what you're looking at. There is some sense in terms of some of the sector relativity, but the whole market's not quite the same. It's interesting. Ford's a great example of one of these ones where, Ford trades on a PE of like 6.8 or 6.9 times earnings. Like, it's actually, when you look at those ones, like the motor vehicles are really cheap as a sector. But Ford's actually expensive relative to some of the European and the Japanese ones. A lot of these trade on 5 or 6 times earnings, as opposed to Tesla, which trades on 100 times earnings. So the whole sector, if you took the whole sector, it's actually not that different to how it traded over like the long course of history. But certainly the last few years, it's been a mixture of these really, really cheap stocks and Tesla. It's sort of like how the industry gets made up. Now the question on these ones, because it's already valued at like a third of the value of the rest of the market, it's sort of that question about, well, it's already a value stock. Is it going to? How much further does it fall? Where does it end up? But so that's certainly the sector we've sort of steered clear of, for some time. And you just don't. They're just not particularly high quality earnings. Like they do get affected a lot by they've got very high revenues and high costs, and there's this little sliver that sits in between that's profit, and it can just get thrown out by these changes. So I look upon Ford and the motor cars as being one of the earlier ones as well. So they're certainly more caught up in terms of the tariffs we saw from Canada and Mexico. So they're sort of in a way they're a month in front of the rest of the market. And so, so there are potential further issues. That what we're seeing there is what you'd expect to start seeing flowing through some of the other sectors. What are the other ones I was going to say? So I do think there's a big reset in numbers. I've got some earnings figures up as a chart I could pop up.
Yep.
So this is the blue lines are the forecasts for each of the financial years, and the red line is the what you call the forward earnings per share. So it's like a weighted average over time. And so I'll use back in 2023, which is about the middle of that graph, is as a good example. You can see that the 2023 numbers are going sideways. They're not moving. You're not seeing increases in forecasts, but you're also not seeing much change in 2024. And so the red line's moving just because every month that goes past, you got one more month of 2024 and one less month of 2023. So sort of that part of, even though we're not seeing forecast upgrading, because there's already this forecast growth in there that's not falling away, that's a good thing. And so as long as that red line's moving, moving up, that's usually when you see markets rising. And so the part where we saw markets falling between the middle of 2022 and the middle of 2023, that was when markets, not only did earnings fall, but markets really fell away at that point as well. And so we have seen this bit of a downturn in the last sort of month or so. That sort of red line's just started to peak down. We're seeing downgrades, pretty reasonable downgrades to 2025 numbers, and keeping in mind that sort of first quarter's already in the bag, and so it's actually just the next there's actually and second quarter's we're most of the way through second quarter already, or halfway through second quarter already. So you sort of only got a little bit more than half of the year to sort of run. So those numbers aren't going to change. They'll change a bit if things get worse, but they're not going to dramatically fall because you've already sort of banked a bit of that. And then the 2026 numbers, that's where you can see some real growth sort of still factored into the market there. And that's where most of the weakness, I think, you're probably going to be looking at is in that. And just to keep in mind that if I put that into a longer term perspective, and this is a log scale graph, so hopefully it does, the falls are a little bit more reasonable in terms of what you're looking at, is that now it's a purple line sort of going up over time. This is sort of back to the early 90s and just sort of showing when you do hit these reasonable sized recessions, you get about a 20% fall, I think is pretty reasonable to expect in terms of the earnings that you'd get out of these. And then in the in the financial crisis, it was more like it wasn't quite halving, but close to halving in terms of those numbers. So the earnings we're looking at the moment have just barely started falling. If we are going into genuine recession, you can knock another 15% at least, I'd say, off the numbers. Even a shallow recession, you're probably 5 to 10% you could knock off the numbers, and that's just going to put all those valuation metrics looking more expensive. So that's one part of it. The other part to remember, though, is markets are always forward-looking, and so if you watch particularly actual earnings and try and sort of base your investment philosophy of actual earnings, that's where you find you'll often lose out because by the time actual earnings start to turn, everyone's already knows that they're seeing all these other retail surveys and forecasts and credit card numbers and stuff like that, and already starting to look at that as a buying into markets and watching them run up.
Yeah, very interesting. And the other thing to talk about is the Aussie dollar and the bond market, right? Because the bond market over the last month had a significant wobble with a significant rise in yields. And, people have said, well, is it Canada selling bonds, or is it China selling bonds, or is it Japan selling bonds, or is it hedge funds unwinding positions that they had previously? And the answer is probably nobody quite knows, but there's probably some truth in all of that. But it does look to me as though the path of interest rates, judging by what the bond markets are saying, is going to be higher than people had thought earlier on.
And so we're talking US bond markets? Yes, yeah. Okay, so yeah, and the other thing, I think there's a large part of what plays out in this is that the US bond market is thought of as what's called the sort of the risk-free asset. And it's the asset that people looked upon to saying, yeah, if I buy that as one of my assets, then I'm not going to lose any money on that. I don't have to worry about them defaulting. And there's a push and shove between the parties about debt ceilings and all that type of stuff. But there's a reasonable part of the Republican Party in particular that wants to keep spending within check, and so I don't think the US is going to be sort of overspending over time. So that's sort of like and that goes into a lot of financial models. Now the question is, is that wrong? So should we, that's where I think a lot of that that extra premium in terms of the yield came from, is that people are saying, well, if that's not true, then maybe we need to charge a lot more for this. Maybe when we're doing all the various option trading and derivative trading that people are doing, maybe we can't use that as our risk-free asset. Maybe we need to spread out and use other countries or a mix of different assets in terms of trying to come up with them. I think there's certainly there's talk about. Last time Trump was in, he spoke about saying, well, maybe we just need to default on some of these bonds, and he's obviously done it for his own country, with his own companies in the past. He was sort of disavowed of that notion by a lot of the people who were around him last time. Will he be disavowed this time if he decides? And maybe he's selective. Maybe he decides, China's been buying a lot of bonds, and they're cheating, and so maybe we just won't pay them all that we owe them. And so I think there's a lot of that sort of going around in terms of an extra risk premium. I think that's going into those long-term bonds in terms of saying, can what people thought was the case may not still be the case.
And there are two implications, right? The first is that means that the cost of debt to the US economy is going to be higher, simply because the interest rates are higher, which is going to create a pressure on the budget. The other, of course, is it has an impact on the exchange rate too. And, here's the DXY, which is the sort of the consolidated view. And you can see it's drifting around the 99, having fallen peak in February of 110. So that's quite a move.
Yeah, that's right. It is. And in Australia, we've sort of been shielded from a reasonable amount of that insofar as our currency's been weakening as well. But, particularly in Europe, the euro in particular has risen a lot against the US dollar. Now, this was actually one of the goals of, depending upon, I think Trump, sometimes you get him on the wrong day and he likes, if you ask him whether he wants a strong dollar, of course he wants a strong dollar, he wants a strong everything. But then you get him with the right person next to him, then he's like, well, actually, no, we need a lower dollar for, to help manufacturers compete better. But it comes back to what Scott Bessent, who is the Treasury Secretary there, and he can talk about this in a way often that can make sense in terms of what he's trying to do.
He's the one.
That's right. He can talk about it in a way that makes sense. Now, whether it flows through and whether there's, and I think I'm sure I spoke last time about it, execution risk is one of the key things to this. But he put out a piece in the Wall Street Journal today or yesterday, and just spoke about this whole idea that it's really about rebalancing trade. It's about restoring the industrial base within the US. It's about growing Main Street. It's about getting deregulation and getting the energy costs down so that US companies can really compete. And taking the government out of a lot of this. So you're not going to spend. It's not going to be government spending. It's going to be private spending that's sort of going to drive the US economy. And there's a lot to be said for that in terms of that if you looked at it purely as a policy tool, if you came and said, well, we've got this economy in the US that's spending too much, the consumption's too high, and because some consumption's too high, they're increasing the debt. And we'll talk. Maybe it's the debt. Maybe people are shoveling so much money that then consumption needs to be spent, or whatever it is. But there's this problem with that. Would a tariff actually help solve that problem? And you look at it and go, yeah, well, that does actually, because a tariff is a tax on consumers, so that helps solve some of the consumption problems.
Despite what he's denied, right? In terms of
that's right. Yeah. And it does, fixes some of the dollar issues. And so that's sort of if you look at it from that perspective, okay, that sort of makes some sense. If you look at it as well from the Mar-a-Lago Accord that is from his head of Council of Economic Advisors, who disavows the whole thing, says, no, you're reading far too much in it. But he basically, his whole process is very similar in terms of saying, yeah, the US dollar is too high. We need to get the US dollar down. How do we get the US dollar down? Well, step one is we need to create leverage. So we put tariffs on countries and we withdraw security guarantees from countries. And then step two is we turn around and use that leverage from those to then renegotiate the so that they get the US dollar goes down and these other currencies go up. And then they take the tariffs off. And that's sort of that whole rebalancing process. So both of those sort of fit with what's being said and what they're doing. The issue is the execution. And that's where the part of this is. If you have this sort of longer term thought out, tariffs are going to increase gradually over this period of time. If you've got an import business, you're not going to go broke tomorrow, but you've got 18 months while we ratchet up, 0.5% a month or whatever it is, or 2% every quarter or whatever. It's going to ratchet these up, and we're going to give you time to change your business models. But it's not just guess what? Next week there's 145% tariff on China. I think if you did that and there was sort of a longer, sort of more, more steady and enunciated, then I think you'd see some of these. You might actually come out saying, okay, maybe that does take you a step in the right direction. The big issue is whether you get a sudden stop in the US economy in the interim, and that's the part which we don't know. I think a lot of economists are very worried about it. There's lots of signs in it. You can certainly see lots of signs in particular industries about it. The question is, will it be bad enough it spreads to the entire economy? The US economy is pretty strong, so it's going to take a big hit. Now, is it enough of a hit to knock it off and then you get the domino effect, that a whole bunch of dominoes fall over? Or is it just enough to knock over one or two and the rest of the dominoes stay up? And so, that's the point we're at. And it's very hard to tell.
It's interesting because the data is a bit complex, right? So we had a low GDP number for the quarter, but that perhaps was explained partly by a significant increase in imports before the tariffs came in. So is that a very noisy number? We had jobs growth that was higher than people had expected. We have consumer confidence that's extremely negative and inflation expectations, which are significantly higher than previously expected. And we've got mortgage rates that have come down a bit because the bond rates came down, and there's a little bit of leeway there, not a lot, but a little. So it's a really confusing picture, and the jobs losses that people were expecting so far haven't really come through. But again, is that a timing question?
That's right. And is there the point where in a certain part, some of the chaos sort of keeps these jobs insofar as it was like, okay, I can see where things are going, and I know there's a tariff on this country, and I know I'm stuffed, and so therefore I'm going to lay these people off because I'm not going to last. But if you're like, if the tariffs stay at this level, I have to fold and go broke or lay off a bunch of people. But if he turns around next week and then all of a sudden adds them back on again, then I don't have to go scramble and go and rehire all those people. And so there's a certain amount of the job part, which is sort of staying in that phase. The question as well on I think reversing course on some of these is much easier than coming to a deal. The deals, like trade deals, tend to take a long time to you're talking 12, 18 months to hash out, and they're just not that simple. And for every example you've got, there's a counter example, and you sort of can't walk in and say this is it, this is the way things are going to be, and not expect to get any pushback on it. And so I think expecting a fast deal from countries is unlikely. I think you're more likely to see delays and tariffs sort of pushed out, and the types of things we've seen. Okay, it's 10%. Yeah, that's going to be delayed another 3 months before we put them on, and then when you get to that point, it's delayed another couple of months, and that it from that. I think a lot of the countries, what we hear sort of secondhand through what's happening is there are countries who are ready, got their trade delegations and all ready to negotiate, but nobody. You need enough of Trump's attention to do it, because a lot of this has driven from him. And if you're talking to somebody who's level 3 down in the chain, it's sort of how much authority does this person even have to negotiate? Whereas traditionally it's like, it's come from the top. It's like, right, this is what we're doing. We're prepared to give this, and we're prepared to give away a bit and take away a bit. You guys go nut out the details, but here's the broad scheme of it. Whereas I think there's so much it's not about nutting out the detail. The detail's yet to come. It's about nutting out the overall scheme first, and you need Trump's. You need Trump there because nobody really knows exactly what it is that he wants to do, and I think that's where coming up with deals quickly, as much as he wants to, they're either going to be sort of bad deals for America, or they're just going to take a long time to sort of nut out. And I think China is one in particular. I've heard a number of people say about the deal Trump did last time with China was actually quite a well thought of deal, like both from the Chinese side and from the US side, of the people who are involved in the detail of it. And so the question for a lot of that, particularly for China, is like, sorry, why do we want to do a deal with you? Like we did one and then you ripped it up. So we don't want to do another one on the back of a napkin because you're just going to rip that up as well when you feel like it. So we want to, we want something that's actually going to last. And so getting to that point is probably not going to be simple. It would be my expectation.
Yeah, and just on that, China's quite interesting because, of course, they came out quite strongly and said, we are not going to fold. We're going to, see it to the end. Was pretty much what they said. And then there was some rumours at the end of last week that, maybe there had been some reaching out, not quite sure who'd reached to who, and maybe there was a rumour of in some initial conversations. But the message again from China said, look, if you're serious about this, we're happy to talk, but it's going to take a long time to work this through. You can't just sort of click your fingers and expect it all to sort of magically fall into place. And I think that's quite an interesting and important observation. Meantime, of course, China has been rapidly reconfiguring its own economy by firstly doing some stimulation inside the economy, trying to get more Chinese to buy more, and also to redirect trade compared with where they were 2 or 3 years ago, which means that whilst they are trade exposed to an extent of what happens in the US, it's not the only game in town.
Yes. So this is a part. There's two parts to this. One is the China stimulus. I'm still not convinced about. It sort of consists at the moment of trying to convince maybe we should lend some more money to consumers to buy stuff. Now that ain't a good idea. That's not,
We've done it in Australia.
Yeah.
Look what happened.
Yeah. Maybe housing you can sort of make an argument for, but look, they've already been trying to lend as much money as they can to housing. Like, there's not a lot more they can shove down that. You start lending, saying, "Oh, let's lend lots of money to people to buy cars." Well, and cars are depreciating assets. It's not something you want to. It's not something you want to own lots of if there's problems going through that. They're not sort of the, you're really hoping to get your money back. And anything else like credit card debt and stuff like that, really? Is that where you want, like people go broke on the credit card debts, you ain't getting nothing back on that. Like that's just rip this thing up and move on. So that's sort of so the China stimulus part, I'm still not convinced about. They keep talking about it, but until I actually see a genuine move to transfer money from state-owned entities and governments into consumers and raise their incomes by a reasonable amount, I'm unconvinced with that. It's really a question of, are you shuffling debt around to try and hide what's going on or try and get somebody else to borrow or whatever? So that's one part of it.
And just on that, the other thing, of course, they have done is to reduce some of the ratios that the banks need to hold with regard to capital. But that is a risky strategy too. That's not actually necessarily encouraging the right momentum, but it's engineering more risk into the economy. Yeah,
it's just one more way of shoving debt, more debt. Can we solve this? Can we solve the problem of more debt with more debt?
Exactly.
Like, no, you can't. You can hide it for a while, but you can't solve it. The other thing then is, which I think is fascinating for Australia, is effectively, like my view of the world comes from this place that there are countries out there that artificially lower their currencies or artificially reduce their own consumption spending in order to manufacture more and pass it out to the rest of the world. And effectively say, look, if you guys want to spend money and we'll take that and manufacture these goods and we'll give it, we'll give you some more money. We'll lend you some more money so that you can buy our goods and then keep our workers employed. Because that's sort of a it feels good from a social cohesion point of view. And I think there's a number of countries in Europe that do it, like Japan, like Germany in particular, and China's definitely done that sort of as a world factor. And so if you have overconsumption, you can either say, oh, that's a moral failing of the people who are doing it, or you can say, no, it's because there's so much money pouring into that country from countries that have free flow of capital. There's so much money pouring into that money's got to go somewhere. And if you run out of things to invest in, then it ends up with consumers and trying to get consumers to borrow more money for houses and cars and all that type of stuff like that. And then they go out and buy too much, and this is where you end up. And so I'm more of that view rather than saying, no, it's just that, certain countries, the consumers just aren't they're just too aggressive or whatever it is that you have. And so the countries that really have allowed free flow of capital and essentially have been running large current account deficits and have got this consumption issue have been the US in particular. That's been the number one, but the UK as well. Australia has been prominent in that. Canada, like it's the Anglo-Saxon nations with this free flow of capital idea, and some countries then sort of effectively taking advantage of that, and in particular China. So the question comes, in a way, effectively what we're saying is, China gives us all this. China gives the US all this money. They use it to bid up asset prices, houses, stock markets, all that type of stuff like that, and overconsume, and then buy the goods from China, and then you just keep going in the cycle. Now, the US is saying we're not going to play that anymore. We're going to stop that. We're going to do it with tariffs. So what happens to the other countries that have got free overflows? So does that just mean that all of a sudden there's just going to be a lot more capital coming into Australia? There's going to be more. We're going to get a lot more cheap goods. All the stuff that China can't sell to the US now anymore, it's going to shove off to Australia. It's got masses of capacity in China, so for a large part, they're going to be wanting to sell it somewhere at reduced costs. And does that mean that we end up with more capital in Australia being bid up into house prices and companies and our debt, sort of trying to encourage our government to get out and spend more? Where does that leave Australia? And I think there's real concerns we should be thinking about, because we are going through a fundamental change in world economies. Australia was running a very similar model to the US, with the benefit of having lots of resources that China wanted to buy, which sort of helped offset it. But I think we're in a position where it's going to be very interesting for the Australian economy. I think lower interest rates are likely. I think partly because this flow of capital, but then also because of the flow-on effect from China not being able to produce as much. And then does that end up being bid up into asset prices and make the whole problem of Australia's housing worse? I think there's a strong chance that is the case.
Well, we'll touch on housing as we go into the Australian economy and the Australian election. But just on the way through that, it is fascinating to look at what's happening, for example, to the iron ore price, right? So the iron ore price is sitting at the moment around 97. That's the one in Singapore. And you can see that it has come down relative to where we were at the end of March. And one of the really interesting questions is what is the fallout effect here? Because if China effectively ends up needing less materials to produce because they're not selling as much at the other end of the machine, as it were, what does that do for Australia in terms of its balance of trade with China, which China is still a major part of the Australian economy? And the recent Treasury modelling suggested that whilst the direct tariff impact on the US, and I think it's about 4% of our overall exports go to the US, so it's not huge. The direct impact, not very significant, but it's this indirect stuff via China and the other, tentacles of the relationships, which is so hard to sort of work out.
So China's, effectively, the way I think about this is you've got I've got a factory sitting in China, and I used to run it at 70 or 80%, and now I've suddenly lost the US, or the US is, whatever that of that 70 or 80%. The bulk of it was going to the US. Now the US isn't going to buy it anymore. what am I going to do? Well, first thing it looks like they're going to try and do is divert it through another country and just keep producing. But I'll cut my margins, but because now I've got to pay off somebody in Vietnam or Bangladesh or Malaysia or wherever it is to reroute it through the US. Maybe I get away with that. In which case, there's probably not as much effect. There's a little bit of effect of I won't produce as much because I won't be making as large profits, but yeah, it'll still be sort of there and thereabouts. Second party, another at the other end of the spectrum is, well, do I just stop? Do I just fold my if there's two factories, one of them closes down and the rest of it just keeps producing to the rest of the world? Do I try and lower my prices and flood Europe and Australia and Africa and wherever else I can with these products and hopefully make up a lot of it by cheaper prices? I think that's probably a pretty good. I think before they shut things down, that'll be where they'll go, is try and flood the market and see what it will take. Now, what pushback do you get? I do think the European Union is going to push back. They have relatively strong regulations around that and a desire to I guess to push back on that. I don't know whether Australia will. It's it's interesting. It sort of seems like it could decimate more of our manufacturing sector. Yeah, it'd be great. We'll all get even cheaper goods and cheaper cars and all that sort of stuff like that. But does that just mean we get rid of another big chunk of our economy in terms of another big chunk of manufacturing and those parts? So yeah, it's
we haven't got much left really already, have we? I mean, our economy is extremely narrow already. So if we lose another chunk, then that's not good news for the long-term prospects of Australians.
No, that's right. You sort of end up in this position where you're like, well, can I dig something out of the ground and sell it to you? Or do you want to come here for a holiday and we'll show you around?
We've got some rare earths. Let's do some stuff with rare earth, which of course is precisely what Albert's talking about, right?
Yeah. Or do you want to move here and we'll pretend we'll give you an education degree as part of it. You pay for an education degree, we'll let you move in.
Yeah. Well, that sort of segues us then nicely to talk a little bit about the Australian situation. And I guess the point of departure here should be the election result. And in the poll that I put up, I basically asked people, has the election result changed your investment plans? Yes, significantly, 23%, just a little, 13%, and 65% not at all, which I thought was quite interesting. So I ask you, from an Australian investment perspective, does it change plans or does it same old, same old?
No, look, pretty much same old. There's a couple of areas. Let me run through some of the sort of broad sectors, and I guess where our sort of thinking goes on this is that for the large part, there really wasn't a lot of difference between the policies of the two parties, and is one part. Secondly, a lot of Australian companies are actually just really global companies. So if you're talking about CSL, if you're talking about Brambles, if you're talking about any of the resources companies, and even some of the things like James Hardie and ones like that, they're not Australian companies. They're companies that happen to be listed in Australia that have global markets. And so while at the very small end of the margin, what's happening in Australia will make a difference, and maybe it makes a bit of a difference in some of their costs or their taxes or whatever it is, largely it's a global play. And so it's just not that affected by what's happening in Australia. So that's one part. Housing is certainly an issue in terms of what's happening in the house market, but it was sort of a flood, two different flavors of how can we get house prices to go up seemed to be your choice there. So it's not really, I don't think it'll make that much difference. Within energy, there was some differences, some real differences. I think there were some negative outcomes you would get if you had reservations, gas reservation, negative outcomes for the big gas players, but that ain't happening. So that's same old for them. I think in terms of immigration, look, who knows which people would do. I mean, last time Albanese said he wasn't going to do immigration. He said he was going to have lower immigration, and then he increased it. This time, theoretically, the Liberal Party would have had lower immigration, but who knows? Who knows what they actually would have done? I know I think that what they say and what they do seems to be quite different in that area. There's probably a little bit of negative in terms of the healthcare stocks. I think the local ones, at least, like your Sonic, as I said, Sonic or CSL or one of these guys. What happens overseas is what matters. But I think there's a general view that okay, well, Medicare is probably going to do a little bit more under a Labor government than what it might have done under a Liberal government, which at the margin is going to be negative for sort of private health, sort of Ramsay health cares and primary health. So I think there's sort of like a little bit negative on that. I still do wonder what's going to happen with the NDIS. There was somebody who made such a good point to me the other day. I've got to bring it up because they were talking about the Australian healthcare system generally has got a real, like, globally, the bang for buck is really, really good, the Australian healthcare system. So we've developed effectively, the government largely negotiates with a lot of these companies to bring down prices as a sort of a group. There's we have a public and a private and a certain amount of insurance and all that type of stuff like that. So, the actual outcomes for the amount of money spent on healthcare tends to be pretty good in Australia. I guess the push, there's always going to be a push between medical people to charge as much as they possibly can, or drug companies, and a pushback from the government. And we've done relative to the rest of the world, I'm sure you can come up with examples of where it hasn't been good, but relative to the rest of the world, we've done a really good job with our medical system. So why did we stuff up the NDIS so badly? Like, why have we handed that over to private companies to do effectively whatever they want in terms of the amount they're charging, and not sort of run this public-private model with, a lot of the single payers and, a lot of the parts where, how do you end up with this where you're routinely hearing about, speech pathologists charging some outrageous amounts that, then all comes back through NDIS rather than going, no, there's a Medicare version, so to speak. This is how much you've got to pay more for it. But, this is what we're paying. So I do think there's that's one area to keep an eye on in terms of we've had such great growth in that, and that I think there's a real underpinning of the economy and the growth we have seen in the economy. We've effectively been in a private sector recession for the last few years, and the NDIS is sort of pushing us higher. Will we actually see any movement on that? I don't think so, but that's one area I'd be sort of urging people to keep an eye on in terms of if we do genuinely see some reform in that area. What will actually happen with it?
And just on that, Damien, this is quite interesting from Alex Joyner. He's actually put up here the public and private demand growth, and showed that actually public sector demand, excluding defence, is up 5%. Private demand 1.7%. So you can see here that it's the government momentum, government investment, government jobs growth. A lot of that is in the caring sector. NDIS directly or indirectly. And of course, there's an argument about, well, the NDIS is providing money to the private sector who are indirectly being funded too. So the truth is, were it not for significant government spend in recent times through public demand, the economy would have gone deeply into recession.
Absolutely. And I do want to highlight as well, look, I'm a huge fan of the NDIS. I think it's great. The overall concept and the support is fantastic. I just hate seeing companies screw the government out of money by and private sector companies. But I think when you hand over too much control to private sector companies, they will charge as much as they possibly can, and the NDIS is allowing them to charge as much as they possibly can. So I think there's that. So net effect, slight positive for some of the energy stocks out of this. Slight negative, I think, for the healthcare stocks. But the rest of it's all pretty much of a muchness. We do have this sort of unrealized gains issue in higher tax rate for super that was meant to come last time, but never got up. The question is, what does that mean if you've got super? I've got a bunch of different things for super. Maybe we might leave that till after. Maybe, Martin, we'll go through some of the tax stuff for super.
Let's talk specifically about super, but just on this unrealized gains, just more generally, there's an important principle here, right, which is just worth reflecting on, right? Because the way the tax system currently works is it's when you actually buy or sell or trade and you make a profit, they'll basically charge you on the profit that you make in that transaction. And that has been pretty much the universal approach to income tax, whether it's income you've earned or whether it's income that you've generated from asset sales or share sales or whatever it is, right? The point, though, that this unrealized gain is moving towards looking at the value of the assets that you have and saying above a certain level, we're going to actually start charging you for the incremental value that has actually moved through the year, even if you haven't realized it.
Yes, that's right.
And that is a shockingly different way of thinking about taxation. And two observations. It's being done in some other countries already. So this isn't totally unique to Australia. It's actually in some European countries. But secondly, it gives the government access to huge potential pools of assets, because you could start with the superannuation and 3 mil as the sort of the cap, and everybody says, well, that's actually not going to touch many people, and remember, it's not inflation adjusted, so that 3 mil in real time is going to come down and down and down. But it also opens the door then to this philosophy of starting to tax assets and asset growth and asset accumulation, asset value, which is a huge open door for a government that's desperate to find another way of taxing people.
Yeah. So I'll start from the overall factor of look. So I run the superannuation funds, and we've got to walk the world super. We'll plug that as well. It's low cost. It's transparent. It's got all these. You get to factor things. What you get to customize it, things in, things out that you want. So I'm obviously a big fan of super. Overall, I have a vested interest in super, and I do think we've designed a product to that we think is great for people to be able to use. So that's where I'm coming from. I do think superannuation, the taxation rates on superannuation are far too low, and rich people within the superannuation system make significant get significant tax concessions that just seem far and above what they should be. And I'm going to show you later on how to get some of those yourself, because some of this part is that I'm not. It's saying, well, there's this huge tax gain from doing it. I don't think it's right that you do it, but I'll tell you exactly what you should do, because this question is, long you get it off.
You play by the current rules for as long as the current rules are there, right?
Yeah, that's right. And so I do have lots of sympathy for, and $3 million is a lot of money. If you based on there's a survey out there which basically says it's AFCA, I think, AFSA, and they do a survey as to how much money do you need in order to have a comfortable lifestyle, and they go through and break out all the different things, and if you've got $3 million in super, you can live that comfortable lifestyle off your dividends. You could be 100% invested in equities, and international and Aussie equities, a mix. Live off the dividends with no problems at all, and see that figure grow by the time you die. So there is. I don't have a problem with saying higher levels of superannuation, and keeping in mind that this stuff turns into zero tax once you're retired. The higher levels of superannuation, you either should just kick it out of superannuation, get it back into your own name, or do something with it. But I do have a philosophical argument about that. Should you be taxing unrealized gains or losses?
Yeah,
because they can swing around. You could all of a sudden, something just before the end of the year jumps 30%. All of a sudden you got to pay tax on it, and 10 minutes later it falls back down. Falls 50%, and you still got to pay tax on the money that you no longer have. And 2 points.
The first there is that there was no clarity as to what would happen if asset values fell. So could you claim a loss in the subsequent year?
I think you can claim my understanding is you can claim a loss, but you can't get your money back. It's not until you have to wait until you make a profit high enough to offset your loss.
Which is other taxable losses, and that's the way the ATO works, right? So you can hold it on your return until later you've got value that you can then offset against it, but you can't get the money back, right? But the second point is, I think this is the thin end of the wedge, because once they've actually got this sort of inculcated in people's minds and started saying, well, okay, taxing asset growth is fine. What about the home? What about stuff outside superannuation? What about Bitcoin profit? I mean, you can just see where this is likely to go. And given the fact that the government has a huge structural deficit problem. Not least because they're not taxing corporates as I think they should, but that's a whole nother story. What it means is that they're looking for an alternative. And this is an alternative, a proxy, if you like, for an inheritance tax or a death tax, right? It doesn't sound as bad, but the principle is what I'm worried about.
Yeah, well, and as a principle, should we? I don't remember the saying from somebody. Are we looking for an economy going forward that basically means, are you going to be? Do you want to be successful based on whether your parents bought a house or not, and how or grandparents bought a house or not? Is that going to be our measure of success going forward? So that in 20 years' time, we have a one class of people whose parents have never owned houses in Australia, and so that they're left renting. And the other the other people who inherited, houses that their parents bought for a pittance and then sold for, $3 or $4 million, $5 million, and then retired to do nothing for the rest of their life. And is that the society which we think we'd like to live in? So, I sort of have these. Well, anyway, we could philosophically talk about a lot of this, but I guess I don't have a problem with saying there are some retirees out there who probably should pay more in tax. Should you have, $5 million sitting in your super, earning whatever it is, a couple $100,000 a year in dividends and interest and all that type of stuff like that, and pay zero tax, while hardworking kids with young families are out there subsidising and paying for your roads and your police force and all this other stuff like that. And so I do think there's an element of that. It's the untaxed part. I do.
Important observation. There's a pivot going on with more younger people than older people. So effectively, the focus is going to have to be more and more on the government saying, well, hang on a moment, how are we going to actually help these younger generations to get through? Because it's unsustainable what's happening at the moment with the lack of affordability for housing, the real income growth very low, et cetera, et cetera. So it's almost like, as eggs are eggs, they are going to go for those assets, those pools that live out there amongst older households. That actually is where a lot of the value is. I mean, just look at the distribution of property assets across the generations, or investment assets across the generations. It's pretty much all lodged at the top end.
Yes, absolutely. And that's where, as I said, that's where we're going at the moment is, there's plenty of stories that people talk about as saying, oh, yeah, Granny bought this house when she was whatever, and it cost her $5,000, which was her annual salary at the time, or half her annual salary, and they just sold it for $3 million last year.
Yeah.
And when Granny died, and it's like saying, well, is that now? Yeah, where does that?
Just answering a quick question from Rory: how does unrealized capital gains tax affect my parents' house? The point is, this is not in at the moment. It's a policy that's being spoken about only within the superannuation umbrella. But of course, if you have a house within superannuation and it went up in value and you're above 3 million, it would be hit.
Yes.
Right? So that's where it is at the moment. My point is. My point is, but later they might just say, well, it's not just within superannuation. It could be property above another value, et cetera, as they seek to extend it. So the question is, where is the slippery slope going to take us to? But at the moment, only in superannuation, only above 3 million, and only if your house is in the superannuation structure. But a lot of people do hold property in superannuation, by the way.
Yes, and so I've also got a post up. I was just trying to find it so I can run through some of the things from a while ago. I should bring this back out again. Actually, given that I hadn't even thought about that angle on that. About why it's a tongue in cheek. Why superannuation is so good. Why property is so good in an unlisted. Sorry, why property is so good in a SMSF.
Yeah.
And the reason why it's not good for you as an investor, but if you're an investor, and I think I used the example of saying, let's say you're a hardworking nurse or a teacher, and you and your wife have managed to, or husband have managed to get together, $250,000, and you've got that in your super, and so maybe to the financial services industry, you might be worth a few $1,000s a year. as a client of their of a super fund. If you instead though take that money and put that into an SMSF in order to get to buy a property, like leverage it up and buy, say, a $700,000 property or something like that, you've just provided now thousands, tens of thousands of dollars of money back to the financial services sector.
Yes.
You're paying interest to a bank, and far more interest than what you pay on it if you bought that outside your super. You're paying some financial planner to do an SOA for you. You might be paying annual financial fees to a financial planner of thousands of dollars a year. You're probably paying your accountant an extra $1,500, $2,000 a year to do all the accounting for you that's on this. You've got all of there's a commission that probably went to somebody to sell the house or buy the house from you. Like, you just look at all the fees that come out, you're going to dust all this money in stamp duty. And so, like, when they talk about the SMSFs in a self-managed super fund, is like there's all these people who are making truckloads of money off you, telling you, hey, this is a great idea, why don't you do this? I'll all of a sudden, start getting thousands of dollars from you in fees. That's why with that industry faced, and now that same industry is now facing, you could be turning around in a few years' time, and if they don't move that rate, you might be ending up paying, and you can't sell that property. So you suddenly get a tax bill for, like, hey, here's a $20,000-$30,000 tax bill for unrealized gain on your property. It's like, oh, what am I going to do with that if that's the only asset sitting in there? Do I have to then go and borrow more money? I don't know. Yeah. It's a quandary. One more reason why you're better off, like, if you want to buy property, buy it in your own name, I guess is where I'm coming to from that. Unless you want to be running an extra few $1,000s a year of costs just to keep this thing alive. And
just remember, 35 billion or something a year goes to people in and around the superannuation industry for doing, I sometimes wonder what.
Yes, there is a lot of money that's there's a lot. And the fees, I was surprised as well. I think when you look at fees for particularly on lower balances, a lot of super funds will show you the administration fees like pretty quickly, and that part looks really easy. And you go, that's there's some fees in there, but they're not that bad. APRA did a study 2 or 3 years ago where they lined them all up and put everyone on a like-for-like basis. And the fees are extraordinary. Like, then, on a $10,000 balance, I think the average fund is like 1.66% or something like that. On a on a $50,000 balance, you're still talking about 1.2% or something like that on the average fund. So and in comparison, the Walk the World fund is sort of, you can go as low as 0.6% or around about 1, somewhere between 0.6 and 1, depending upon what assets you choose and all that type of stuff like that. But it's there's big money, and it's one of the few industries. They've stopped handing out superannuation licenses. They're now actively trying to get all funds to merge as much as they can, which is sort of this interesting, because they want to get fees down. Which is, it's one of the few industries in the world where somebody says, you know what, we really need lower fees. What we need is less competition. So
how does that work? Yeah, exactly.
Yeah, that's right. Well, they've said, we'll get it all from economies of scale, but yeah. I don't know.
I'm a bit suspicious of that. Now, let's then move on to the conversation to talk specifically about superannuation, right, and some specific observations that you've got. And I think this is a really important time of year, right? So we're heading up towards May, June, 30th of June, of course, the end of the tax year. So I guess some questions about what we should be thinking about this year, and also what potentially foundational work should be done for next year.
Yes, that's right. Let me bring up I've hidden this on a screen now that I've taken off. Okay, I think in broad sense, though, you need to think about this as in a couple of different ways. So one way is, what we want to do with superannuation is, there's a way of reducing your immediate tax by moving money into superannuation. And the broad sense of it is, for the first $30,000, you're only getting taxed at 15%. And then the next, after that, you're only getting taxed at 30%. So if you can put extra money into your superannuation, And even if you're on $100,000, and your marginal tax rate is sort of 30 something percent, you can basically halve your tax that you're paying on that. So you want to put another. So if you think about it, flip it the other way around, and you go, okay, well, if I had $10,000 that I wanted to save pre-tax, then, or $10,000 pre-tax that you wanted to save, if you took that into your own name, you'd only end up with 6,800 of that, or 7,000, sort of around about that level. If you instead put it into your super, you'll end up with 8,500. So you're going to get a 25% gain on day one. And it's pretty hard to find a 25% gain on day one anywhere else in terms of that. So you've got to make a lot of investment mistakes before that sort of ends up. Now, if you're 20, look, you're not going to get that money for half a century, and so, well, it's less of a, it's obviously less of a concern. If you're anywhere close to retirement, though, that's a big kick, and certainly anyone in their late 50s, early 60s. You'd be saying shove as much as you can through that, because you get that tax gain straight away.
And just a quick word of caution: you got to be careful, because you mustn't go over the 30K in total, right?
Yeah. Okay. Well, after you go over 30K, it's you get your tax rate's 30%. So if you're on the top tax rate, you will have to pay the money. Like what hurts for people is they actually let you put the money in, and then they come back and go, so you stick $10,000 too much in, and they come back and go, oh, I need $1,500 from you at tax time.
Yeah.
Now, that's the part that hurts people. But the thing is saying, well, yeah, but if I had have taken it out of your super at 47%, it would have been $3,000 you would have paid.
Yeah.
So,
and just to be clear, what it does, it reduces your declarable income in your own name by the amount you put across, right? And your tax is a lower rate within the superannuation structure, 15% initially, which means that it's actually worth quite a lot. And then, of course, if you hold it to retirement and then take it out, well, who knows what it's going to be like in sort of N years' time.
I'll get on to the retirement one, because that's sort of the second part. There's sort of like there's one part about reducing your income. The second part is then saying money within super earns you get much lower tax rate while it's in there. And then finally, once you hit retirement, it's tax-free. So there's thresholds and there's other bits, but as a large part, you want to have as much in that super when you retire, when it moves into pension phase, because even if you've got, say, $100,000 sitting outside of super, if that's earning anything, you're probably paying tax on it. You get it inside of super, there's no tax. Now, well, I did talk about the fairness of that, but let's get the fairness aside. That's what the rules are. So you want to try and, so one is save yourself some money on that tax. So the second part of that is then if you have, say, a non-working partner or somebody who's got less, it is worth thinking about splitting your payments and working out what you can get into their name as well. There's a number of different low income things, and we can help you with those. So if you want, jump on the Walk the World website, register your email address, and we can certainly help book in if you want. We can certainly help you with some of these. But there is a number of ways you can contribute money on behalf of your spouse and help your tax situation. And there's 3 or 4 different ways of splitting, and partly as well, this whole $3 million, which you think is pretty likely to come on, it is a good reason to try and even out your super balances if you've got if you have one partner earning a lot more than the other partner. Because if you get to the stage where you get to retirement and one of you's got $4 million sitting in super and the other one's got $4, is you might be paying all this extra tax on the $4 million. That if you had $2 million each sitting in super, then that might be avoided. So there's that part about how do we do that. The other one about lowering your existing tax one. Now this is for young people as well as old people, is that you can say if you're a first home buyer or you'd like to be a first home buyer, you can use the tax rate in your super fund to save. And that gives you that same benefit I spoke about. So if you wanted to save $10,000 a year, a little bit less than $1,000 a month of pre-tax money, you take that in your own name, you're ending up with $6,800. You put it into your super fund, you've got $8,500. You're 25% better off on day one. If your tax rate's higher, you're even further in front. So the thing with first home buyer super though, once that money's in there, the only reason it can come out is to buy a house. So for some people, that's good. It's like, yes, I'm doing this for the discipline of saving it. I know I don't, but if you all of a sudden decide, hey, I'd really love a round the world trip instead, no, that money's there. You can take it out for a house. You can't take it out you can take it out. There's hardship stuff, but I'm pretty sure your round the world trip or buying a new car or whatever it is you might want to do with it is not going to be treated as hardship. So so once it's in there, it's in there. And again, I suppose if you move to a different country, that it's in your super. You'll eventually get it, but it's locked up there. Now, the only super you can use is the additional super you've put in. So if your employer is paying you 11.5% at the moment, soon to be 12, you can't use that money. The compulsory super you can't use as part of your house deposit. You have to put in money over and above to get that benefit. Okay, so that's a few different ways of saving money. One is that extra contributions. Secondly is the extra contributions through your employer. Secondly is getting it into your spouse's name in various ways, and particularly if they're lower income owners. Third way is the first home buyer. And the fourth is the non-concessional, where basically you can, and with these, there are bring forward, where you can actually do the last 5 years. If you haven't been doing it, you can do sort of bring forwards of it. And so in this case, it's money you've already paid tax on. And so what you can do is put that money into super and then claim a tax deduction for it. So, if I've got a spare $1,000 and I don't have that, I haven't reached my caps, or I've got spare caps left over from the last 5 years, I can put that into my super, and then on my tax return, I'll claim a tax deduction for that. So that's lowering your income right now. Then you've got the parts about, can I get the money into the super for, how do I get more money into the super so that you don't have to, so that first of all, it pays a lower rate of tax as an ongoing rate. And secondly, once you hit that pension phase, it's in a tax-free environment. Now, there are limits as to how much you can do for this. Basically, you can contribute about $110,000 a year, but you can make up the last couple of years as well, as long as your super balance isn't too high. And so, there's definitely benefits of saying, if you have money saved in your own name, or shares saved in your own name, and you're thinking about living off some of that, moving that money across into your super can be tax advantageous. You don't have to wait until the cutoff doesn't happen when you're retired as well. I think the cutoff is 75. So you do have, and you can do that every year. Every year you can just shuffle more and more of your assets into super, and and have that have that benefit. Oh, sorry. And the other one I did miss as well is if you're close to retirement as well, you can go into the part where you just try and shovel most of your salary into super, and just in order to get that balance up. And so you do want to try and even those out, as I spoke about. And then the other one is there's a few different things you can do with trying to reduce the taxable. If you do pass away, there is a tax paid on money that's in super that gets paid by adult children who inherit that money, or adult children or grandchildren. The money that you put in from your own assets that you put into it, that doesn't get taxed at up to 15% or up to 17%. Sorry. The money that you got from working, that will get taxed. And so there are strategies, and if anyone's interested in that, we can certainly help you with those strategies as well, in terms of saying how do you reduce the tax burden if you do happen to die that gets passed on to children. The one I just told you, Martin, 10 minutes ago or 20 minutes ago, that I think is justifiable in terms of that. There's plenty of strategies around reducing that amount.
Yeah, I think that's right. And one other, which I'll just bring onto the table as well. If you are actually above a certain age and you downsize, you actually have the capacity to put a capital amount from that property transaction directly into your superannuation. And again, you've got the same sheltering after you've put it across. And that's a number of people have actually started to do that with the downsizing that's going on at the moment, I see.
Yeah, so I think that's up to 330, I think. No, up to 300, I think.
300, I think it was the last number I had in my head.
Up to 300.
Yeah.
Yes.
So the point is, there is a bunch of different things that you can do based on where you are from a life event perspective, right?
Yeah.
But this sheltering that the superannuation structure gives is actually quite compelling once you actually understand it. It's probably less compelling if you're a higher taxpayer to an extent.
No, it's no, I disagree. Low taxpayers, it's less compelling. Like if you're only earning 20 to 50,000, it might be pretty borderline. There are caps and limits. Once you get too much money in there, then you can get caps and limits where it makes it less advantageous for rich people. But the interesting thing as well, like certainly you'll hear a lot of people complain about this 30%, and especially now that if it looks like it's going through, you'll hear people complain. If you ask those people, oh, okay, so you've got $5 million sitting in your super, and now there's this extra tax on 30%. Why don't you just take $2 million out and leave it in your own name then? Oh, no way. I'd pay way more tax if I did that. No way I'm doing that. I don't want to pay tax on it. I just want to pay less than, So I think and that's the crux of the super part is in all these cases where people have complained about it, if you offered those people and said, okay, well, we talk about the franking credits. Oh, I never would have put so much money into super. If you said to them, okay, well, fine, I'll let you pull out the money, the extra money you put, and you can have it in your own name instead. They'd be like, no way. It's still way better in super. And that's, I guess, the overall point is the intention of the government is to give you super is meant to be a tax advantageous way of saving so that people put more money in that. You can't take it out for a holiday or buy a new fancy watch or whatever it is until you're retired. That is the intent. And so it is extremely unlikely that I would ever see that. I would expect to see tax rates in super that are worse than owning it in your own name. I just think that's, Well,
it would destroy
such an extreme risk.
It would destroy the whole philosophy of what the superannuation system was set up to try and do, right? Which was to stop the government having to pay a lot of pensioners, into the future. So,
So if you're worried about, maybe if I transfer too much money into super, the tax will be worse. I find it very, very unlikely.
Yeah, and it is very important to get good advice on this. So, it's complicated and there are traps for the unwary, but, we've suggested an approach and a way of getting more information.
And the main point why you're saying why this time of year is important. Look, you've got up till the end to 30 June. And actually, when I say 30 June as well, I'd actually say you've probably really only got to like 15th of June or something like that. There's a lot of super funds will have cutoffs about when they'll allow these to come through in terms of the payments. So don't wait until the 29th of June and decide, I'll slot it all in and everything will be fine. You've sort of got a month and a half to sort your stuff out. But certainly go to the Walk the World site. Sign yourself up and book in if you want to have a chat about any of these. We certainly have got people who can help you, but it's now's the time you need to be doing that. You can save up all for 2025, and then you can probably do the same strategy again next year.
Yeah. And, whether you agree with superannuation or not, whether you agree with the taxation arrangements or not, they are the rules, right? So you have to click within the rules as they are currently defined by the politicians and their advisors. The risk is, of course, they could change, but that's always been the case.
Yeah. And it's this part where you go, well, I don't agree with it, but why don't I save myself 10 or 20 grand worth of tax? And then I can use that to donate to causes that I might actually like rather than paying it to the current government.
Yeah, absolutely. Now, just a couple of questions that came in. Of course, the superannuation funds have trustees. The trustees of the superannuation funds have responsibility to ensure that the superannuation funds are run for the benefits of the members. And somebody was asking about things like bail-in and what have you, right? Those trustees do have an obligation to do the right thing for the members in the fund, don't they?
Yeah, that's correct. The other thing to note is there's a number of funds out there, and our funds are run in this way, in that where they're running what's called separately managed accounts or managed discretionary accounts. And what that means is the assets within that sit within your name. And so and what that means is it's your tax consequences that you don't have to worry about other people's. So what do I mean by that is, if you're sitting in a fund and say you own Nvidia, and you're just a normal super fund, just throws everyone's assets into one. The fund owns X billion dollars worth of Nvidia, and they might be sitting on this massive capital gain for that. Now somebody gets paid his pension today, and then your payments go in tomorrow. So the guy gets paid his pension, they take out $3,000 and sell some Nvidia. Then you add your $3,000 in, and they go back and buy back Nvidia. So one, you've done a transaction you didn't need to do because he sold yesterday, you bought today. But secondly, that's realized capital gain within Nvidia that now you. Even though you weren't the one to sell, you're actually out there buying more assets. You've got this capital gain you need to pay, and you need to pay the tax on that. And so because it's all one asset. Whereas if you've got it in a separately managed account structure, then it's, if you're not selling, then you don't have to worry about the capital gains on those. You can just keep building and compounding it as time goes. So that's one benefit. Some of the funds as well, the way they're structured, and the super funds, the industry funds get in trouble for this all the time, is that so we run super for via various different companies, but that sort of aggregate up. But if I want to go and spend money on marketing, or if I want to take my clients to the tennis or whatever it is that these guys got in trouble for, I'm going to spend my money. I charge a fee. I've got to take that fee out of this. Whereas where a lot of these super funds were getting in trouble was the money that they're spending on advertising is actually members' money. And their argument is, we're trying to increase the number of members to reduce to bring the cost down. And so, Martin, I'm going to spend some of your money to advertise in order to get new users, new people, so that we can grow the pool, and then you'll have lower fees. And it's like, well, just a minute. And then you're like, well, yeah, but I also need to take these people there's some big clients I want to get on, and I just need to take them to the tennis and spend a few $100,000 on box seats. So you wouldn't mind, Martin, if you chipped in to help us take these guys to the tennis.
Help yourself. Exactly.
Yeah, that's right. It's only your retirement money.
And you may never know, because of course the disclosure with regard to some of the funds and what they do and where they spend their money and where the fees go, it's hard to find out, isn't it?
And might be very strong. I think it is almost certain you won't know. Yes, but yes. So there's definitely issues around that in terms of the way different funds are set up, and so and that's endemic in the system.
So as we come towards the end of the show, the last month has taught us a few things. What do you think the main lesson that you've learned, Damien, over the last month?
Oh, right. Look, I think I said to you last time. You questioned me as, am I going to see markets higher or lower next time we speak? And I said probably lower. But my confidence in how much confidence do I have in my own forecasting at this point in time is pretty low. And I'd say that's still the case. It's very, there's a number of different ways things can go. There's a lot of downturns, a lot of big downturns we've seen in the past where markets took an initial tumble. Financial crisis was classic for this. Took an initial tumble, made it all back again, and then fell again. And a lot of that return up was retail investors who, they're hearing Pavlov's bell ringing and salivating, and markets have fallen. They always bounce back, and they do eventually always bounce back, but sometimes it takes a while. Now, the question is, are we in one of these periods where markets have taken a tumble because everyone's gone, just a minute, the whole world could get shaken up. We're going to see supply chain disruption. All these things are going to happen. And so therefore, they're right to be falling. Or has the world taught itself some resilience through supply chain issues that we've just been through, this massive supply chain issue. And so maybe we know a lot more about supply chains than we once did. And Trump's going to reverse a lot of stuff, and so maybe it won't be anywhere near as bad as what people at first thought. I'm still more in the former case, but I think with all this, you need to stay pretty humble and say, well, this is what I'm expecting to happen, but you need to be prepared to change with events. And so I'm still expecting more disruption, but I'm aware of the the factors that could lead to not disruption. And this is the month we will see how much disruption there is. And this is, I guess, last time when we had the initial ones with the Trump, oh, it's on, it's off, it's delayed or whatever like that. There's always this part of, okay, he's just going to keep delaying these. Because I can't remember how many announcements he's made about them, but I think we're up to 70 or 80 different announcements we've made, and most of them just get pushed back. But we've genuinely seen a stop in containers. Like that's if he reversed tomorrow and said, you know what, China's now my best mate. There's no tariffs on China. We're going back to zero tariffs. They're going to start sticking stuff on ships. They're going to start making stuff to stick stuff on ships. There's still this hole they're going to go through, and the question is, how much damage does that do? What's the capex? So and that's your bet. I'm pretty sure that's not happening. Yeah. But the whole how much damage does this do? That's we're going to see over this next month. Look, what's that, and does there do further dominoes fall once they start to fall? That's where things get nasty, or we'll turn around and go, hey, the US economy held up far better than expected.
Two observations. A lot of the big trading banks did a huge amount of trading, and their recent reports showed huge value to them through this high volatility. So there were some winners as well as some losers.
Oh, right. Oh, yeah. That's that's when a stockbroker tells you to buy one day, sell the next day, and buy back the next day. He's just made triple his money. Could have just told you to buy once and forget about it. But exactly. That's a stockbroking makes money from turnover, and so that's those foreign exchange guys that do as well. That's they're very big into that. Yeah.
So hence the talking heads, and they keep changing their tunes. The other thing is, and the point I want to underscore is, nobody knows how this is going to play out, right? You can talk about different scenarios, you can talk about likely scenarios. So it's always worth thinking about, but what if the alternative happens? And, have some alternatives in your head so that you're not faced suddenly making or trying to make a decision at the wrong point in the journey, right? So I think it's more important than ever before to be armed with some alternative thoughts about how things could play out.
Yeah, absolutely. It's not about zero, not about having no stocks. It's not about having 100% stocks. It's trying to pick a level in the middle. Next, sorry, I should have mentioned that when I was talking about the some of the super things as well. I've had a number of them already where people are like, look, I want to give you some extra money. I want to transfer money in from my own name into my super fund or whatever it is, some of those strategies you're talking about before. It doesn't mean you have to stick it straight into stocks. We've got people who are like, yeah, look, we're going to dump it straight into cash, and then we're going to sit there and we'll wheel it out over the next 12 months. It doesn't, even though it comes in as a lump sum, doesn't necessarily mean that, it needs to be invested straight away. So, whether you're doing it within our fund, we're certainly a lot more flexible than others, but there are some other funds as well that you get some flexibility.
Absolutely. And what we're trying to underscore here is it's worth getting educated. It's worth getting to understand some of these issues so you're not caught. And with the 30th of June coming up, think about some of the things that we've been talking about today, and you might be able to actually develop a strategy which is more beneficial in the long term for you. So that's part of what we're talking here. Damien, thank you so much for your time as always. There's links to the World Fund and everything else to do with what we've been talking about that you can follow in the comments below. And I'll look forward to picking up the conversation again in just over a month. I think we're slightly different to next month because of other timings. So I look forward to that. And meantime, hang on to your hat. It's going to be an interesting ride.
Yes. Thanks, Martin. Catch you next month.
Take care. Bye-bye. There you go. Hope you found that interesting, educative, informative, and links and things below if you'd like to follow on and follow up. Just to say that next week it'll be me. I'll be talking about the latest from my modelling, and we're doing some postcode analysis and some of the other things that are going on with regard to the property market in the light of the election and some of the other things there. So that should be fun. And the dogs are still here. They've both been asleep most of the time. They seem to have moved their bed slightly, but I'll just move the camera. There you go. There's the doggies looking as though they're ready for the next walk. So that's my next task for the day. Anyway, thank you very much for spending some time with us this evening. Take care. Have a good week, and look forward to seeing you next week on the live show. And of course, we'll be putting up recorded shows every day of the week. Meantime, this is Martin North from Digital Finance Analytics signing off. We'll see you next time. Take care.